Good morning, viewers. You are welcome to Sunday Benga Akoni online tutorial. And this is the concluding part of our lecture on concept and need for assurance. The part 3 of the lecture that has been started sometime late last year. So, in our earlier lectures, we've discussed the objective of audit and assurance. We also talk about small company audit exemption. We've talked about rights and duties of the auditors and so on. So today we want to talk about scope of an audit, and that is the point at which we will be starting our lecture for today. The scope of the statutory audit described in the independent auditor's report contains the following points. An audit involves performing procedures to obtain audit evidence about the amount and disclosures in the financial statement. Take for instance, if in the statement of financial position it was stated there the value of building 800 million naira. So the procedures the auditor will perform to substantiate that amount is the first thing. If you want to audit for the existence, the auditor will require to be taken to where that property is located and he will go and inspect it personally to ensure that it actually exists. You will also inspect the document with which the company acquired the building, like deed of conveyance or deed of assignment, whichever one. So to confirm that it is the company name that is on the document, and it is the company that is buying that has actually bought that property. Then he may also take a further step to write to the company's lawyer, because there is no way the company will acquire a property without involving her lawyer. So the auditor will also write to the company lawyer to confirm whether the information about the building is correct. So then the next thing is that the procedure that the auditor will select depend on his judgment, including the assessment of the risk of material misstatement of the financial statement, whether due to fraud or error. So he will assess the risk of material misstatement. The risk of material misstatement could be assessed as being high and it could be assessed as being low. So then the next thing here is that in making those risk assessments, the auditor consider internal controls relevant to the entity's preparation and fair presentation of the financial statement in order to design audit procedures that are appropriate in the circumstance, that is in the circumstance of the client that is being audited. But not for the purpose of expressing an opinion on the effectiveness of the entity's internal control. So lastly, an audit also includes evaluating the appropriateness of accounting policies used and the reasonableness of accounting estimates made by management, as well as evaluating the overall presentation of the financial statement. So from here we go to advantages and limitation of an audit. Advantages and limitation of an audit. So an external audit offer a number of advantages, as we will see, as it will be discussed in the course of the lecture. So an external audit offers a number of advantages which include: one, it improves the credibility of published financial statements. So an external audit adds credibility to the public financial statement. Even in some companies that are exempted from audit, can be categorized as small companies, the audit of such company can offer some assistance. For example, if you want to borrow money from the bank may require that they should provide a published an audited financial statement, and because the bank is sure that by bringing an audited version of their financial statement, credibility will have been added to those financial statements. So then number 2 here is that it confirms to management that they have performed their statutory duties correctly. So management statutory duty are the duty required by the law, require that the duties that law require the management to perform, and one of them is that it is the duty of the management to prepare and present the financial statement of the company. It is also the duty of the management to design and implement an efficient system of internal control that will prevent and detect fraud that could lead to material misstatement of the financial statement. And it is also the statutory duty of the management to assess the going concern status of the company. So an external audit will confirm to management that they have performed their statutory duties correctly. Then the third one here is that it provides assurance to management that they have complied with non-statutory requirements such as corporate governance requirements. Where such requirements are subject to an audit or review. Then lastly, or number 4, it provides feedback on the effectiveness of internal controls of the client, where internal controls are weak or inadequate. The auditors will make recommendations for improvement this will help management to reduce risk and improve the company's performance. So that is that about the advantages of the external audit. So we now want to go to the limitations of external audit. Limitations of external audit. Number 1 of that is its cost. The cost of an external audit can be very high. However, where the audit firm is already hired to perform some non-audit audit work such as account preparation or advisory work, then the cost of the audit can be fairly small. So yeah, then number 2, disruption to the client staff. The client staff may be required to assist the auditors by answering questions providing documents and other information. And the third one is that some items in the subject matter. So when I say subject matter, in the context of an external audit, it simply means the financial statement. Some items in the subject matter might be estimate whose true and fairness would be known at some point in the future. This means that the assurance opinion would be subjective and judgmental. Then, number 4, no matter how robust a client system may be they will usually introduce they will usually contain some inherent limitations. Then lastly, 5, audit evidence is persuasive rather than conclusive. Full stop. And the last thing we shall be considering here is assurance on internal control. Assurance on internal controls. See, the management of a company, they have some duties and responsibility to perform, and one of those responsibilities is that it is the duty of management to quickly identify the risk that the company may be facing. Then they have to design and implement internal control with which they will address those risks. So assurance providers or auditors, practitioners, they offer some certain level of support to management in achieving those responsibilities. And example of those support they put is by writing and submitting what is known as type 1 and type 2 reports. So we start with type 1 report. Type 1 report. So a type 1 report, it contains a description of a service organization system, the control and the control objective at a specified date, which is going to be prepared by the management of the service organization.